I'll share 10 evergreen super important investment lessons that will help you in your investment journey. A few years later, when I was sitting at my desk in my office, my managers were discussing wealth and investments. I heard that discussion for half an hour, but I didn't get a single thing because I don't have any idea about the investment because nobody taught me in my school. And I started researching on my own, and here am I to provide you some key learnings from what I have learned from the past 5 years. These learnings are super important and super relevant if you are interested in investing and generating wealth over long run. So let's get started. The Psychology of Money by Morgan Housel. Wealth production is as important as wealth creation. There are a lot of examples that shows people who have generated wealth quickly, exhausted quickly. People think that good investments is taking good decisions, but it's totally opposite. Good investment is avoiding bad decisions. We know that we should take risks to gain returns, but the priorities should be calculating the risk and planning to protect it against the uncertainties and downfalls. A simple example for this is a stop loss. When you are investing in the stock market, you should be calculating your risk before entering into the trade, and you should place your stop loss in the system. This way, you will limit your stop loss, also your stress. The actual wealth is not what we see, but what we can't see. There's a difference between being rich and being wealthy. Rich people are often noticeable because they look rich with luxury cars, luxury homes, etc. While the wealthy people invest in assets and become more wealthy, this kind of people look simple like everyone. In this society, people judge your wealth by your spending capacities, but it's totally opposite. Wealthy people reinvest their money and scale their wealth and achieve greater flexibility. The Warren Buffett Way. Quick investment decisions are often wrong decisions. It's often seen that people emotion changes when price changes in the market. We assume that good things are happening when the price of the stock goes up, and we end up buying that stock. After some time, the stock starts to go down, then we quickly exit that position and end up losing money. It happens because of one reason: measuring price performance based on short-term data, short-term price movements, and taking quick decisions. This is a poor mental habit that one needs to control and improve upon. Avoid FOMO in investing. Investment is business, and treat it like a business. Invest in only businesses that you believe in. The difference between a newbie investor and an experienced investor is the newbie investor wants to buy the stock when its price is rising up, and the experienced investor buys the stock at a discounted level, which means when the stock is at its support zone. The newbie investor panics when they see negative news about the stock and they quickly sell off. The experienced trader dig deep into fundamentals and decide on their own. The Little Book of Value Investing. Treat investments like a marathon, not like a sprint. In this current era of modern world, patience is very rare. Everyone's looking for quick results, even in investing. But let me tell you, it doesn't work that way, at least in the investment world. It's unlikely that your investment will double or skyrocket in a day. Instead, treat it like a plant that grows big over the long time. You don't cut off plants if they are not growing. Instead, you wait until it grows, no matter what. Same with the investments. Think about long term. If you are kind of person who is not patient and who is not willing to be patient, then investment is not for you. It's common to have downfalls in every business. Don't panic. Few investors are likely to sell off their shares if they find out that the stock has failed to reach the expectations of quarterly earning report. But it doesn't mean the business is going down. It's a temporary drop and it will recover to its intrinsic value. Smart investors utilize this opportunity by buying stocks when they see the price below the intrinsic value, and later they enjoy the profits when it goes back to its intrinsic value or above. Rich Dad, Poor Dad. Great investors don't work for the money, rather their money works for them. Starting with the basics, everyone needs to work for the money. But smart people utilize that money to make money. No matter how small amount you are putting in, with consistency and discipline, it will grow. For example, a small restaurant owner doesn't have to sit and maintain the restaurant with his time. Rather, he can hire a person to maintain it. And then the owner can plan to scale the business and open branches in other places and multiply the revenue. Invest in assets, not the liabilities you think are assets. Smart people invest in assets that generate wealth over long term. And other people think that they have invested in assets but they are actually liabilities. For example, being a couple investing in a big luxury house where there are a lot of costs involved in acquiring and maintaining it. On the contrary, a smart investor would buy a simple house and use the extra amount to buy an apartment and give it to rent to generate income. The intelligent investor. Learn from your mistakes and never give up. There are a lot of investors who lose money in business and they quit. There are only few passionate investors who learn from their mistakes and keep growing. Think of it in this way. Mistakes and losses are part of the game. Understand that the losses you are making are the charges of what you are learning from it. Even the great people you see on the internet have gone through the same tough time and used their experience to step up in the business and achieve great heights. Investing is not a gambling or a guessing game. It's a real business. A lot of people in the market call themselves investors and predict the market without any data. When you are in investing world, every step you take and every decision you make should be backed by some reason and data. But how to know potential ups and downs of a business? Fundamentals like free cash flow, price to book ratio, return on equity, dividend payout ratio, price to sales, dividend yield ratio, debt to equity ratio, etc. And importantly, you should have trust in the business so that you will be confident over long term. Share your thoughts and learnings if you have any in the comment section below.